Hey everyone, we are going to be trying something new this week with a little short video going over what to expect as we head into the new week. I've gotten some requests from a few of you out there to possibly do some more videos along with the daily and weekly posts. It sounded like a cool idea, and so here we are. I am sure as I do this more, the quality of the video, audio, and of course the content itself will get better. For this one, I'm kind of just winging it to get a feel for things and to kind of see how it goes. So any feedback will definitely be appreciated. With that being said, let's just get right into it. So we know last week S&P was down around 150 points, and the expected move was around 120. So it was roughly a 1.2 standard deviation move to the downside. So in the month of June, we actually had two breaches to the downside or the lower end of the expected move. The first one was here kind of early in June, where we saw this big drawdown when NASDAQ was kind of the one leading the way down. And then, of course, just this past week, we kind of had a little bit of a down move. So, um, it's been a while since we've seen some kind of sustained downside action. As we know, all throughout March, April, May, and even into June, it's just nothing but upside. We actually had multiple breaches to the upside here throughout, kind of this up move. We had some crazy gaps and some crazy price action to the upside, and it seems to have kind of tapered off the last few weeks, and we're kind of just kind of chopping up and down in this range. I expect more of that to kind of continue as we kind of head into this week. Geopolitical tensions are kind of back at the forefront of things. So it'll be interesting to see how oil and even the metals market kind of reacts this week. But I think we'll see more of this chop. We saw this earlier, late last year, earlier this year, kind of where S&P was just kind of chopping up and down, and finally it had kind of a big move. We can go back further in time, and there's a lot of examples of that. Obviously, the move doesn't necessarily out of the range have to be to the downside, but that's kind of what we saw the last time. We kind of chopped around for almost a couple of months in this range where, we had big swings to both sides, upside, downside. And I feel like we're kind of just getting started with that right now. As price kind of coils in this area, eventually, we'll see a big break either to the upside, to the downside. That's kind of always the unknown of the market, right? But right now, I think it's kind of in agreement that we're kind of entering this consolidation period. Kind of started as June did, and we've just kind of been building up a lot of pressure in this area, and I think that's going to continue. So, as we head into the new week, we have about 128% point expected move. A little bit higher than last week, and it's actually a shortened week. So we only have 4 trading days this week. The market will be closed on Friday because of the 4th of July holiday. So shortened week, but roughly equal, maybe even slightly higher expected move kind of gives us that idea that implied volatility is still, sticky. It's still trending up, at least in the short term. I know a lot of people look at VIX, but we have to remember that VIX looks at 30-day implied volatility, and what we're looking at here is the weekly implied volatility. So the weekly implied volatility is around 21 right now on SPX, and VIX is hovering around 18. So that shows us that short-term implied volatility and 30-day implied volatility are kind of in backwardation right now. There's more risk in the immediate short term than maybe 30 days out. Generally, right, we see that inverse relationship where there's more risk long term and lower risk short term. So that's kind of been thrown out of whack here, and I think a lot of that is because of geopolitical tensions and just the big swings and drawdowns that we've had over the last couple of weeks in both the S&P and of course the Nasdaq kind of leading the charge there. So the upper end, the expected move is around 74.82. Lower end is 72.26. 74.82 is kind of where we started the week last week. This is Monday's candle right here. Um, and the lower end of the expected move is kind of around this giant wick we saw on the 9th of June. So funny enough, actually, this entire candle here from June 9th is our expected move. The high of this candle was around 74.80 and the low of it was around 74.30, and you can see these numbers kind of align with that. So you don't see that too often where the entire week range is just kind of the body of one single candle, but that kind of signifies how important and how big just this drawdown was on June 9th. So that candle's kind of coming back into play, and I think those ranges are coming back into play. Um, Not too worried about the upside. I think there's a lot of, trade that's occurred up here. We chopped around a little bit here a couple of weeks ago. We chopped around this area when we kind of first got to it in May. The focus actually is the lower end here. So um, from the 72.26 or even kind of the 72.30-ish area that we had earlier in the month, if you look on the chart, there's not much else down there if this area is to break, right? Maybe there's a little bit of area where we chopped around in mid-May, maybe around the 7,100, maybe even the 7,000 area where we wicked over here. But even still, that's maybe 200 points lower from where this week is expecting to go. So just something to keep in mind. I think there's kind of just a cliff if price gets down here. I don't think we're obviously getting anywhere near here unless things get really crazy in the Middle East or something. But I definitely want to keep an eye out on this area between, let's just call it 7,000 and 7,100. Um, maybe we don't get there this week. It's a shortened week, holiday week, summertime. I've kind of written a lot about it, and we know the market tends to generally drift higher in the summer, low volume, people are on vacation, etc. It's kind of quieter months anyways in the market. And um, I think this year is going to be a little different. Last year we saw just, crazy upswings all throughout June, July, August, out of that whole Liberation Day thing. But I think there's a little bit more factors in play this time around. So a shortened week kind of, I guess, saves the bulls there, if you will. Maybe we don't see a complete collapse this week, but I definitely want to keep an eye out on what happens if S&P starts breaking the lower end here. Not just this week, but also heading into July. This is really going to be the critical level in the low 7,200s, because I think there's not much there between there, the 7,200 level, and completely fallen below towards 7,000 again. So um, the bearish cases have never worked out the last 15, 18 months, whatever it is. We've had some sizable corrections of about 10%. This one was roughly 5, but uh, I think this year's is probably going to be a lot different than what we've saw last year. We started the year out with some volatility, and it's kind of stuck around with just some crazy moves, right? 20% in just a matter of weeks. So that volatility hasn't gone away, and I think it's going to come back into play as we head into July. But for this week, right, we'll just stick to the weekly expected move, 74.80, 72.20, let's just call it. That'll kind of be the level to watch for. Again, shortened week. We're going to be rolling into a new month and a new quarter, so new money coming in. From various pension funds, 401ks, etc., especially quarterly rebalancing for a lot of funds and portfolio managers out there. So maybe, like I said, this week we don't see too much volatility, and then of course the holidays. So Wednesday, Thursday should be maybe a little bit quieter than Monday, Tuesday. So that's going to be the main thing to kind of watch for. Um, the other thing I kind of want to bring into play here is the moving averages. I'm going to go ahead and add those real quick. But the 50-day moving average is kind of in play, which it hasn't been in quite some time. So we actually closed below the 50-day moving average for the first time in, well, a long time, right? So right around here at the end of March, early April, we broke over the 50. We kind of came close to it earlier this month. And now here we are, and we're below it. We actually closed below the 50-day moving average for the first time since, let's just say, late March, early April. And it's the first time we've actually broken below it since early March. So maybe it doesn't mean much yet, right? We're still kind of clinging onto it. We're just below it by a hair. Obviously, the lower end of this candle was clearly below it, but we've closed right around it. Let's say the 75, 73.50 level, give or take. Um, but that'll be something to watch for. If price continues to break down and we're continually below the 50-day, that could again put some more selling pressure into the market. So that's just something else to keep an eye on as we head into the week. The midpoint of the week is 73.54, which is right around where that 50-day moving average is. So definitely keep an eye out on this level as well. We might see S&P try to gravitate towards this level, especially with a shortened week, right? lack of volatility and whatnot. So just something to keep in mind. But yeah, that's it for this one. Just kind of short, kind of sweet. Like I said, we're just getting started with this. We'll see how these videos turn out in the future. Obviously, I plan to add more content to them. This one was just kind of focusing just on SPX and the expected move, but we'll talk about some more things as we start doing these on the regular. Thanks everybody, and have a great week.